Okay, good morning, good afternoon, good evening from wherever you watch me from. Welcome back everybody and welcome back to the channel. Today we'll be looking at how to create a strategy that actually works. If you're here for the first time, I'm Mr. Towas and I'm going to be your trainer for this short period, okay? That's me, I'm Mr. Towas. I'm going to be your trainer for this very short period. So please pay attention. If you're not an old subscriber, then please kindly subscribe to the channel and hit the like button just for the algorithm to push the video through, okay? So I'll give you 3 seconds to do that. Just do that to help the channel. Okay, thank you for doing that. Thank you for subscribing and let's begin. Okay, so creating a strategy that actually works. Creating a trading strategy that actually works. When we say a trading strategy that actually works, what does it mean? As traders, to even think of trading, which means you are a trader, as traders, our ultimate goal is to buy an asset class and hold for some time, sell it, and then we make profits. So for instance, let's say a chart, let's say just example, just a chart is moving. So a chart you decide to buy somewhere, as you can see here, I bought here in this zone, that's some long chart ago. You buy and you hold and you make profit out of it. So let's say you can make profit of 1,500, you can make profit of 2,000 per trade. You can make like any amount depending on your capital. So that's the ultimate goal as a trader, is to buy and hold and sell, or buy and hold, and then you take your profits and you're out of the market. So we can do that only with a strategy, a very good strategy, a strategy that actually works. That's the only way we can buy and sell and make profit out of the market. And irrespective of where you are and who you are, whether you are in any place, all what you need to do that is you need a computer, you need your trading skills. First, you need your trading skills, you need your computer, and you need a very good internet connection to be able to do that, just to buy and sell and make some profit out of the market. As simple as that. But interestingly, as interesting as it sounds, most people don't have a very good strategy they use to trade. They begin trading the market, either forex market or stock market, and they learn some strategies, they learn more strategies, but none of them actually works for them. Because when they say a strategy does not work, it means when they buy, they end up losing and they end up blowing the account, which means the account keeps going down. So let's say they begin trading with $3,000. Instead of them to make some profits and top up this $3,000, they keep losing and losing, and until the account is blown to, let's say, $200, and they've lost the account. Eventually blow the account to 0. And this becomes a trait. They keep doing it and they keep losing because they're not using any good strategy to trade the market. But today I'm going to show you why. To create a trading strategy that actually works, let me clean this. To create a trading strategy that actually works, you must actually understand something. You must understand that strategies are created around the basic and the fundamental behavior of the market. So let's say you are trading any chart at all. Your strategy is going to revolve around the fundamental or the basic characteristics of the market, how the market actually moves and how the market behaves. So we know that in simple terms, market can only move in 3 directions. Either the market is moving upwards, right? The market is trending upwards. This is one direction. Market is trending downwards. This other direction. And market is moving sideways, or the market is ranging. We call it in trading, we call it the market is ranging. These are the only moves the market actually moves. So the question is, along these phases or along these moves the market is moving, how do we buy, or where do we buy, or how do we create a good strategy around these moves for the market to be able to make profit for us? To be able to do that, you must understand that market moves in this direction, but they behave around some important principles that you must understand. First principle you must understand is support and resistance. Support and resistance. When we say support and resistance, what does it mean? In the market, if the market is ranging, for instance, the market creates a range here. Over time, this area becomes resistant because the market has touched the same area. You realize that the market hits the same area multiple times. So that area becomes a resistance. If the market comes down, hit a particular zone several times, that area becomes a support. Okay, so within these two ranges, you can look for trading opportunities. You can look for trading strategies around this particular kind of market movement. So let's see that. Let's come down here. Assuming that this is the mode of the market moving, because market will not normally move perfect as it is, but most of the time it's going to behave as you see down here. So in the same scenario, when you see that the market hit a particular zone where the market has already hit before, you look for opportunities and then you take the market down or you take the market up. That's what we meant by trading support and resistance. So support means you are on the top floor. Let's say if it's a building, this is the down floor, you are standing on the down floor of the building, right? If this is a support, the resistance is going to be the one upward, because if you are trying to break through, it's going to resist you. So here is a resistance. If it's multiple floor building, then here too can become a support for another guy who is standing here, and the resistance can be somewhere there. So market moves in support and resistance almost on every chart. So you must understand how this support and resistance works and how to create a strategy around them. 2, market moves around demand and supply. Demand and supply. Most people get confused between support and resistance and demand and supply. When we talk of demand and supply, we are looking at aggressive movement in the market. Let's say that the market begin to move, trending, then all of a sudden there was a big crash. So the question is, what actually happened and market reversed its original direction? Because the market was moving this way, but all of a sudden there was a big crash in the market. That area becomes our supply zone, because more sellers are here trying to sell the market. So it becomes our supply zone. Supply zone happens when there's a lot of pressure, a lot of selling pressure, and there was a big crash in the market. That is supply. That is not resistance, guys. That's supply zone. On the other hand, let's assume that market is also moving on the downside. So market is trending downside. Then all of a sudden, there was a huge up movement. Then that area also becomes a demand zone. And keeping the names in your mind doesn't actually matter, but you must actually understand what they mean. That when you see a big crash, it's either going to be a demand or a supply. You can even exchange the names. It doesn't matter, because one demand is somebody's supply on different time frames. So exchanging the name does not even matter. What matters is that you must understand that demand and supplies occurs around areas where there were big crashes in the market, not support and resistance. Support and resistance happen within short ranges. While demand and supply happen within long range. So we see that over time, while the market is trending, market crash. And market will also begin to trend for some time, and then there will be a huge reversal or a huge crash. This is supply and demand. So now you understand support and resistance, you understand supply and demand. Now, the next concept you must also understand if you want to create a strategy that actually works is what we call breakout. You see, every strategy you're going to create is going to be around this particular principle, the market move. So, understanding breakout. When you say a breakout, what is a breakout? Let's come back to support and resistance. There is a resistance around this zone preventing the market to hit through. Now, eventually, market kept moving and there was a break. This is what we call a breakout, because the market has been able to break out of a very strong resistance zone. So it is a breakout. In such mode, you can also look for trade opportunities around that zone. You can create a strategy around this particular method or this particular principle. That's what we call breakout. The same way when there's also supply or anywhere the market tries to resist several times. So resistance, and eventually market break through the strong resistance. We call it a breakout. So in breakout, we can also look for trading opportunities in breakout areas. Now, one thing you must also know is what we call trend line bounces. You know that market also moves on trend lines sometimes. So let's say market is moving up, move, retrace, up, move, retrace, up, move, retrace. You realize that when you place a trend line across, market will also be bouncing off the trend line because there was a touch and a touch, which means the market is moving in diagonal manner. So that is what we call trend line bounces. And sometimes trend line bounces also happen to moving averages. Moving averages are like, as you see, these lines on my chart are moving averages. We'll talk about them later. When I open the chart, you see how they behave and how they work. But I want you to understand is that market strategies or trading strategies are always created around this simple principle, how the market moves. Let's see Fibonacci level. Trend line bounces, Fibonacci level. When I say Fibonacci levels, I'll talk about that one later. We will go into the chart. So you must understand that markets can only move around these important principles. So if you are creating a strategy, then your strategy must revolve around these important principles. So most people begin to learn trading. They begin to learn trading and they learn a lot of strategies, but none of them actually works for them. What actually the cause of that? Let's see some charts here. This is AUD JPY chart I took some time ago. It's been a while, and we are on M15. And you can see that I took some trades here. You could see, can you see? So from this side and this side. So the question is, why was the trade taken there? What can we see on the chart? Is the strategy, how come the strategy worked? Okay, so you can see that on the chart, we have moving averages on the chart. And one thing you could see is that the market was actually bouncing off, right? So move, retrace, move. The market tried to come to bounce off the moving average again. You could see it bounced off the 100 moving average. This is actually 100 moving average. It came back to bounce off and gave a confirmation pattern. So that's where I took the trade and I took my profit target here. You see, so if you're able to master how market behaves around these important zones like the trend lines, the Fibonacci levels, the support and resistance, then you'll be able to create good strategies around them. Let's see another example. This is the Switch Yen chart. This is also a chart I took some time ago, still on M15. And you could see that the market was actually ranging. So the same support and resistance and demand and supply concepts. The market was ranging. You could see down move, up move, touch a zone, came back, touch a zone again. That's where I took the trade. And you see, the trade was taking, profit was taking here. The same concept of demand and supply and support and resistance. The same concept. Market came back to hit the same zone again. You could see that I also entered here again. My stop loss is here. Can you see the stop loss? Take profit target is here, but the market, before I took the screenshot, the market had not hit the take profit target yet. So you could see there are two trades on the chart. The same support and resistance concept. Where is the support and where is the resistance? Yes, can you show me? Where is the support? Where is the resistance? The same way. Market moves, it's moving. You see the market begin to range. So you can create support and resistance around the zone. And you can trade. Very simple. You look for opportunities around. If the markets come to touch or come up to touch or maybe come down, and maybe if you have not taken a trade here and the market gives you a confirmation pattern here, you can also take the market upwards. That's simple as support and resistance. Support and resistance also happens in a larger range. As you can see from here, I drew two trend lines, two rectangular lines, and you could see that I took one trade here. So the range was very huge because that was where I knew it would give me high probability of trading. This is very, very, very simple. You just join the market and you take your profit. So you must understand how these basic concepts work. If you understand support and resistance, demand and supply, breakout, reversals, trend lines, and Fibonacci levels, you'll be able to trade successfully and make some profit out of the market. So the question is, how do you actually create these strategies? Okay, to create a trading strategy, you must understand a trading strategy is made up of a setup, a trading setup. You must understand that a trading strategy is made up of a trading setup, a trading position sizing, risk reward, and maximum drawdown. These are the concepts you must understand if you want to create a perfect trading strategy that actually works. After you have understood how you are going to create a strategy around basic and fundamental important principles of trading or of any chart, now you should be able to understand that trading strategy itself, when you take a strategy as a whole, is made up of these components, at least these basic 4 components. That is the trading setup, the position sizing, the risk reward, and the maximum drawdown. So how do you understand all this? Now, when you say a trading setup, it's a way you are going to buy in the market. So let's say, for instance, my trading setup is to buy breakout. Okay, which means that I'm looking for areas where market is ranging, and then if I see opportunity around the zone and there is a breakout, let's say there's a breakout out of this zone, I'm going to, and the market reverse back, I'll look for confirmation and I'll join the market upwards. This is what you call a breakout. So this can be a trading setup, right? That's a setup you have in your mind. The question is, what is your entry criteria? The entry criteria is what? The market must break and reverse back to the zone. That's all. Then when you give confirmation, what is your stop loss criteria? Okay, if I enter here, then your stop loss should be somewhere here. Simple. What is your take profit target criteria? Okay, if my stop loss is here, then my take profit target is going to be somewhere up there. So you see, this is how a trading setup is created. You must have all these plans written down. Let's look for another example. Someone will also say that, okay, my trading strategy, my trading setup is going to be, I want to trade the bounce, because it's the same principle, the same principles we learned previously, the same principle we are going to use. Okay, I want to look opportunity around the bouncing markets. So I'm going to look for areas where the market is trending, and I'll draw my trend line, and if the market comes back, gives me a confirmation like maybe bullish engulfing pattern or bearish engulfing pattern if you're going down, then I will take the market and join the trend. So you see, that is your trading setup you're looking for. Basic principles, we use it to create trading strategies. Where is your entry criteria? Your entry criteria was to find what? Was to find the bullish engulfing pattern. So you enter after the bullish engulfing pattern closes. Where is your stop loss criteria? Your stop loss criteria is to place at a good place. Maybe you have to, okay, I'm going to count about 4 candlesticks backwards or 2 candlesticks backwards. I'm going to set my stop loss. Where is your take profit target criteria? Okay, if my stop loss is $400, then my take profit target will be $800. So I'm going to make $800 anytime I have a winning trade. As simple as that. So as simple as understanding basic principles of bouncing, you'll be able to create a strategy. Now, after you have a trading setup and now you have all these components ready and you don't understand position sizing, then you're not going to do anything, because you're going to actually have a losing business. What is position sizing? It's about how much of your capital you are willing to buy or sell. If you are willing to risk $400, which means how much capital do you need to be able to risk $400? Let's say that on the average, your account is $3,000. $3,000. So how much of position are you supposed to take? If you have $3,000, can you risk $400? No, you can't risk $400, because in position sizing, your maximum you are supposed to risk, advisable maximum, is supposed to be 1 to 5% of your account. 1 to 5% of your account. So let's say you are even trading 3,000. 5% of 3,000 is going to be, well, let's start from 10%. 10% is going to be $300. So 5% is going to be $150, which means the maximum you should risk on an account of $3,000 is supposed to be $150. So in such scenario, when you take a trade, let's say you have a strategy and you're taking a trade, then you have to size your position well. It means that if you have a losing trade, you are risking only $150. So $150. And if you have a winning trade, you are winning how much? As twice as $150. So your winning trade is going to be $300. You do that to be able to build your account. As simple as that. What if your capital is $5,000? Let's say you have $5,000 in your account. 10% of $5,000 is $500. So 5% of $5,000 equals $250. Which means if this is your strategy and you've taken a trade, then your risk should be just $250, which is your stop loss, $250 stop loss. Take profit target should be what? $500. That's what we call position sizing. You size your position well. If you don't size your position well, you can't even calculate your risk reward. So risk reward should be at least 1:2. Position sizing should be at least 1 to 5%. Have you seen? Then if you're able to combine this, you are creating a strategy that actually works, because the only thing that works in trading is the mathematics behind it. Most people think that what works in trading is the strategy. The strategy are going to trade. Hey, where is the strategy? Okay, this is reversal. If reversal comes, then I see reversal and I'm going to buy upwards. And I'm going to buy. Okay, fine. You will buy, but in an event where there is adversity, you have nothing to protect your trading system. So after you have a trading setup, you must have position sizing criteria, you must have risk reward criteria, and you must have what you call maximum drawdown. When you say maximum drawdown, the question is, this your 5,000 capital. How much are you willing to lose? In case you are still losing, how much of the 5,000 are you willing to lose? Let's say, okay, I'm saying that my maximum drawdown of 5,000, I want to hit, if my account hits 50%. If I lose 50% of my account, I'm going to sit down and review my trading system if I'm doing the right thing. So assuming that your capital is 5,000 and 50%, which means you are going to reach what? You are going to reach negative 250, so 2,500. So you tell yourself, if my account draw down from 5,000 to 2,500, then I'm going to pause trading and I'm going to review whatever is going wrong, because you should never blow your account as a trader. Someone may decide to choose, okay, I want my maximum drawdown should be, let's say, 30%. Which means that if your account draw down 30%, you pause trading and you evaluate your trading system, your strategy, if they are actually working. If they're not working, you shouldn't blow your account. So you see, if you don't know this mathematics behind trading, you don't know how these things are calculated, and you think trading is all about the charts, it's all about clicking the buy and clicking the sell on the chart, then you are getting it wrong, because you can never make profit. Your strategy will never work. You get a scenario. So you must have all these things down to be able to create a strategy that actually works. You have your setup, you have your entry criteria, stop loss criteria, take profit target criteria, position sizing, how much of your capital you are supposed to size, risk reward, how much risk reward are you taking every time, the maximum drawdown, how much of your account you are allowed to draw down if the market is not going in your favor. On the other hand, it could be that when you also started trading, your account will begin to grow from 5,000 to, let's say, 7,000, 7K, from 7K to as maybe 10,000. But the whole question is, isn't everybody who will be able to do that? No, you can't do that every time. That is why you must have your maximum drawdown. You must have maximum drawdown set even before you begin trading, so that in case the market is not going in your favor and your account keeps coming down, when you hit your maximum drawdown target, you now stop and you begin to revise your trading system to see if what we are doing makes sense, or you are following a complete trading as you began from the beginning. Yeah. Or you are following a good strategy as you began from the beginning. So if you want a strategy that works, you must follow all these principles to be able to create a strategy that actually works. If not, you are going to have a losing business. Okay, trading is very simple, because it's just about clicking buy and clicking sell. But on the other hand, despite the chart you are going to see, there is actually a mathematics behind whatever you are going to do. It's not just about clicking buy and clicking sell. There's mathematics behind whatever you're going to do as a trader. So please focus on these calculations. That's the only way you can build a strategy that actually works. Okay, if you don't do that, then none of your strategies are going to work. You will learn several strategies and you will not be able to make profit out of the market. But don't forget, there is no any serious hidden strategy. The strategies are all created behind the basic principles and the basic movement of the market, like the bounces and the ranging and other stuffs. Just the basic principles. That's how we trade as traders. But what makes the trading strategy works are the calculations behind the trading strategy. These MERS calculations, this is what will actually make your trading system work. That's what will make your trading strategy works. Okay, so please pay attention to it. Now that you've learned this, maybe you didn't know it exists. This is actually what I teach in my training program. So if you want to join that, you are always welcome to join my training program. Okay, just click on the link in the description below, and then you can chat me on WhatsApp or send me an email. But now that you know this, please go and sit down, open your charts, open your book, and jot down so many things. Okay, then this guy said this. What am I doing? What is my setup? What is my criteria? What is my entry criteria? What my take profit target criteria? What is my position sizing? What is my risk what I'm taking? What is my maximum drawdown? If you have maximum drawdown, guys, you will never ever blow your account. You will always become profitable in trade because your account can never go to 0-0. Guys, follow these principles and it's going to help you. I'm Mr. Towas, and I'm glad you've watched up to this level. Please, if you're not subscribed, kindly subscribe to the channel and hit the like button. And until then, take care of yourself and see you next time. I'm signing out. Bye.